Silicon Valley Bank collapse, the second largest bank failure in U.S. history, has been the fastest failure of a financial institution ever. Just to give you a little perspective, in a span of under 40 hours, depositors withdrew a whopping $40 billion. That's $1 billion getting withdrawn every single hour. In 2008, Washington Mutual lost $17 billion of deposits over 2 weeks before being shut down by regulators as the largest bank failure in U.S. history. Silicon Valley Bank lost 2.5 times that in a single day. Why? Because now you basically carry a bank branch in your pocket or wherever it is you attach this to your body. Will the U.S. government start to regulate the use of your phone or smart devices to withdraw funds to prevent this type of systemic failure? We'll have to see. Silicon Valley Bank mainly held deposits for tech startups and their founders. Deposits into Silicon Valley Bank jumped from $60 billion in 2018 to $189 billion in 2022. Now, the way that Silicon Valley Bank makes money is by a process called net interest margin. So they pay you perhaps, let's say, 0.2% on your savings account. They invest that money for a 1% return and they profit 0.8%. 80 billion of the 189 billion that they held for these tech startups and the rest of their customers went into mortgage-backed securities. They got back a return of 1.5%. Problem was that a lot of these investments into mortgage-backed securities were classified as long-term liabilities, and they were secured by short-term deposits. So as interest rates go up, bond prices fall. So it makes sense to buy, let's say, a 20-year mortgage bonds when the yield is higher than, let's say, U.S. Treasury, which is one of the safest investments that you can make. If Treasury yields are just as high as mortgage bonds, it's safer to put the money into U.S. Treasuries because they're a lot safer. Mortgage bonds, they're not backed by the federal government. U.S. Treasuries are. You're left with mortgage bonds that no one wants because U.S. Treasuries are in investments that are just as safe. So if you are making just as much as with U.S. Treasuries as mortgage-backed securities, you might as well put your money into U.S. Treasuries. And that's how marketers will approach that type of opportunity. So you have to sell your mortgage bonds at a loss so investors can still earn more money than what they will make as depositing money into U.S. Treasuries. In other words, investing in U.S. Treasuries. Let's say you've got mortgage-backed securities that are giving you a 1% return, right? But you also have U.S. Treasuries that are giving you a 1% return. You might as well put your money into U.S. Treasuries. And in order for you to recoup that money that you already deposited to mortgage-backed securities, you're going to have to sell that at a loss so investors can make 2% off of those mortgage-backed securities. And that's basically what happened with Silicon Valley Bank. They're suffering from a liquidity crisis because they were holding $80 billion of their assets and securities, which had fallen in value. So they had to sell stock and a number of assets at a loss of $1.8 billion. The crypto-focused bank Silvergate failed a couple of days ago. So VCs, they told their portfolio to yank their cash out of SVP. And the withdrawals just went viral. It was a tidal wave of people withdrawing their money. They needed access to this money in order to operate their businesses. 85% of Silicon Valley Bank deposits are over $250,000. That means that they are not protected under FDIC. However, you've been hearing how the U.S. government is releasing all kinds of credit and funding facilities to ensure that everyone gets their money from Silicon Valley Bank. So what happened was Signature Bank customers withdraw more than $10 billion in deposits last week. That became the third largest bank failure in U.S. history. So U.S. regulators now have taken over Signature Bank. Signature Bank had 40 branches, assets of $110.36 billion, deposits of $88.59 billion at the end of 22, according to regulatory filing. Signature Bank was founded in 2001, business-friendly alternative to the big banks. Has West Coast expansion, and it opened up to the crypto industry in 2018. They allowed for a 24/7 payment network for crypto clients, held $16.5 billion in deposits. First Republic received more than $70 billion in untapped funding from the Federal Reserve Bank and JP Morgan Chase. This is to also prevent systemic failure of that financial institution. Banking regulators released what's called a bank term funding program. So the Fed facility will offer loans of up to 1 year to banks saving associations, credit unions, and other institutions, those taking advantage of the facility, will be asked to pledge high-quality collateral such as treasuries, agency debt, and mortgage-backed securities in order to get this funding. Yet regulators are saying that the U.S. government is not bailing out these financial institutions. According to a statement released by multiple regulatory bodies, there will be no bailouts or expenses for taxpayers related to the proposed loans. However, shareholders and certain unsecured creditors will not receive any protection and will lose their investments. In other words, this money to not bail out these banks is coming from federal banking insuring reserves, not taxpayer money. The U.S. government had to provide this protection for these financial institutions because no one wanted to buy Silicon Valley Bank. The federal government had to step in because there is a risk of multiple banks failing. Several banks that are under duress include, but are not limited to, First Republic Bank, Signature Bank, PacWest Bancorp. The Federal Deposit Insurance Corporation, the federal agency that insures up to $250,000 of the money that you deposit into an FDIC-backed account, had a plan to get uninsured depositors' money back in 2 tranches. Uninsured depositors are those people who have over $250,000 in an FDIC-backed account. Half of the money would be available to these uninsured depositors in a couple of days, and the other half would be available in 3 to 6 months. The FDIC basically trashed this idea because any plan that required people to wait an extended period of time would not work. Investors, as a result, started withdrawing their money. Reportedly, Silicon Valley Bank customers would get back their money today. When a bank has to assure that there is no problem, there is a problem. Nonetheless, First Republic has suffered a 64% stock price drop after suffering a 33% drop last week. PacWest Bancorp dropped 32%, and Western Alliance Bancorp lost more than 50% as regional bank stocks fell sharply. Zions Bank Corporation shed 19%, while KeyCorp fell 23%. Other financial firms were also under pressure as Bank of America slipped 3%, while Charles Schwab tumbled 9%. The Spider S&P Regional Banking ETF lost 10% on Monday following a 16% decline last week. Even if you are not invested in any of these financial institutions through the stock market, the failure of Silicon Valley Bank may still affect you, especially if you're trying to generate revenue online, perhaps through Etsy. A number of people started to make masks and put them up on Etsy, and perhaps they still have businesses that may suffer as a result. Just to give you some context, SVB was founded over a poker game in 1983, and since many tech startups could not get normal credit cards or loans from big banks, they would get it through SVP. Silicon Valley Bank did business with well-known tech companies including Shopify, Pinterest, Fitbit, and thousands of lesser-known startups, in addition to established venture capital firms like Andreessen Horowitz. Roku, the TV streaming provider, was among the companies caught in the middle to the tune of $487 million, it said in a regulatory filing on Friday. At this time, the company does not know to what extent the company will be able to recover its cash on deposit at SVB. Officials at Roku wrote of what amounts to about 26% of the company's cash. I've got the Amazon Fire Stick. Nonetheless, people still use Roku to go ahead and view whatever it is that they want to stream online. However, Etsy is more pressing matter for those people who are trying to generate revenue online using a platform such as Etsy. Etsy is warning sellers that the collapse of Silicon Valley Bank on Friday is causing delays in processing payments, according to an email from the company shared with NBC News. The online do-it-yourself goods megashop said it used SVB to facilitate disbursement to some sellers and that it was working with other payment partners to issue deposits. We wanted to let you know that there's a delay with your deposit that was scheduled for today. So will eBay pick up a number of people that will not want to use Etsy? Well, this is what's happening on eBay right now. Sellers on eBay are trying to auction off Silicon Valley Bank branded merch, including a cardboard box for $201 and a wine cooler for $42. So it's something that's trending. When something is trending, you typically want to do something. You want to be able to leverage whatever it is that you could sell to hop on that trend. I've got your attention. Whenever a financial institution is crashing, it's good to keep an open ear to the grindstone. Again, your revenue may depend on using some of these applications that worked with SVB, Etsy, Bill.com, and others disclosed SVB disclosure on Friday afternoon. Etsy sellers began posting on the e-commerce company's community forum, All Things Finance, expressing worry about their funds that Etsy held at Silicon Valley Bank. Are we going to get our payout? Wrote a poster representing Madeline Lane Boutique, a shop that sells tutus and princess costumes. Another, Bill.com, which provides financial automation software for businesses. I use Bill.com. Said on Saturday that it has about $670 million held at Silicon Valley Bank, including approximately $300 million in corporate cash, cash equivalents, and short-term investments, and around $370 million held in trust on behalf of its customers. The company said that it has a total of approximately $2.6 billion of corporate cash and equivalents held at multiple financial institutions and about $3.3 billion held at multiple institutions on behalf of customers. Watch the video you see on the screen right now. Click the subscribe button and click the bell notification to stay on top of what's going down.